Hey everyone, and welcome to today's deep dive, where we're going to be tackling, I think, one of the biggest questions on a lot of investors' minds, which is
Yeah,
active versus passive investing.
really important.
So we're going to break down both of these approaches,
Absolutely.
look at the pros, the cons,
Mhm.
and really try and give you the tools to feel confident making the best decisions for your portfolio.
It's all about making informed choices, right? It's your hard-earned money we're talking about here. So
Exactly.
you don't want to be just, throwing darts blindfolded.
Definitely not.
No, you really want to understand what you're getting into.
Yeah. And speaking of getting into things,
Mm.
um, have you ever sat there and you've daydreamed
Oh, yeah.
about finding the next Microsoft and just becoming like this,
Stock picking guru.
stock picking legend?
Yeah,
Everyone wants to be that, right?
absolutely.
But here's the thing.
Hmm.
That dream of finding those hidden gems and getting rich quick,
Hmm.
it can actually lead to some pretty serious investing mistakes.
It's true. And, that's because it kind of plays right into this allure of active management. This idea that, there are these expert stock pickers out there who can just consistently beat the market and bring in these like crazy high returns for you.
So it's like I can just hire someone to be my financial superhero
Kind of.
and just like sweep in and save the day and make me rich.
Yeah, the marketing definitely makes it sound that way sometimes.
Yeah.
But in reality, it's a little more complicated than that.
Okay.
So active management, we're talking about professionals
Right.
who are constantly buying and selling stocks within a portfolio.
Okay.
They're trying to outperform a specific benchmark,
Mm.
like the S&P 500.
Got to
And they're doing tons of research. They're analyzing all this data and trying to time the market and pick the winners.
It sounds like a lot of work.
It's a full-time job for sure. But, that's their expertise. It's what they're supposed to be good at.
Right. Right.
But there's a catch.
Hmm.
And it's not always as glamorous as it seems.
Oh, I see where you're going with this.
Yeah, we've been digging into some research, and it turns out
I know.
there are these like 6 major pitfalls of active management that investors often overlook.
Mhm.
And these are the reasons why this seemingly winning strategy might not be all it's cracked up to be.
Okay, so let's call them like the 6 reasons why active management might not be the path to, easy street.
Exactly. Let's break it down.
All right, ready?
Okay, so first up,
Hit me.
upfront sales commissions.
I can't even think about those.
A lot of people don't, and it's a big one.
Okay.
So when you buy into an actively managed fund,
Yeah,
you often have to pay a commission right away,
right off the bat.
right off the bat, just to get in the door.
So like let's say I want to invest $10,000
Okay.
and this fund has a, let's say, 5.75% sales commission. That's $575
Yeah.
gone before my money even starts working for me.
It's like starting a race 50 yards behind everyone else.
Exactly, and that's just the beginning.
Oh, yeah, we're just getting warmed up.
Oh, this is making me nervous.
The second pitfall is higher daily costs.
What are your daily costs? What do you mean?
So we're talking about expense ratios.
Oh, okay. These
These ratios cover all the behind-the-scenes stuff.
Okay.
The fund manager's salary, research, administrative expenses,
So that's all the costs of running the fund, basically.
Exactly.
Okay.
And actively managed funds typically have higher expense ratios compared to passive funds.
And why is that?
Well, they're doing a lot more work. They're constantly buying and selling, trying to time the market.
I see. Makes sense.
All that research and analysis comes at a price.
Right. And so do I just pay like a higher percentage every day or?
It's not exactly a daily fee, but it does eat into your returns over time.
Okay, but even if it's a small percentage.
Even a small difference can add up big time. We're talking potentially costing you a fortune over your lifetime.
Wow. Okay. That's definitely something to think about.
You don't want to underestimate the power of compounding working against you.
No, definitely not.
And speaking of things that can quietly chip away at your returns,
Oh, what else is there?
let's talk about the tax drag.
The tax drag.
This is a sneaky one.
Okay. How does the tax drag work?
So when a fund manager is actively buying and selling stocks within a fund,
Yeah.
it can trigger capital gains distributions.
Okay.
And these distributions are taxable events for investors who hold the fund in a taxable account.
So even if I haven't sold anything, I could still be owing taxes.
That's right, just because of the fund's trading activity.
That's not what you want to hear.
No, definitely not. And actively managed funds tend to have higher turnover rates.
So more trading, more taxes.
Exactly.
Okay, so we've got upfront commissions, we've got high daily costs, we've got tax drag.
Yeah, 3 strikes already.
This is not sounding good.
But wait, there's more.
Oh no.
Number 4, underperformance.
Underperformance. But I thought the whole point of hiring these experts was to beat the market.
That's the idea, but the data tells a different story.
Oh, this can't be good.
There are studies that compare the performance of actively managed funds to their benchmarks.
Right.
And year after year, most of them just don't outperform.
Really?
It's harder than it looks to consistently pick winners and time the market perfectly.
So you're saying even the pros get it wrong most of the time?
Pretty much. And as the time horizon increases, the percentage of active funds that fail to beat their benchmarks gets even worse.
So the longer I'm invested, the more likely I am to lose.
Statistically speaking, yes.
Wow, this is really making me question everything I thought I knew about investing.
It's a reality check for a lot of people.
Okay, so we can't count on consistent outperformance, but what about those, like, legendary funds with amazing track records?
Ah, yes, the superstars.
Surely some managers must be able to keep winning year after year, right?
Not so fast.
Hmm.
That's where we get to pitfall number 5, which is the lack of consistent success.
Okay, so even if a fund has a few good years,
Right?
there's no guarantee they can keep it up.
Exactly. It's like those one-hit wonders in music, you know. They
Yeah.
come out of nowhere, everyone loves them,
Right.
and then they just disappear.
So it's like investing based on past performance is kind of risky?
It can be very misleading.
Hmm.
A classic example of this is Bill Miller's Legg Mason Value Trust Fund.
Okay, I've heard of that one.
This fund was legendary back in the 90s and early 2000s.
Yeah.
They beat the market for 15 years straight.
Wow.
It was incredible. Investors were just throwing money at them,
Like a,
hoping to ride that wave of success.
but did it all just come crashing down?
Pretty much over the next decade, Legg Mason Value Trust went from hero to zero.
No way.
Yeah, they ended up in the bottom 1% of all funds.
That's a wild swing.
It just goes to show that even the best can stumble.
And is that like a common thing, or is that just like a...
It's more common than you think.
Really?
A lot of those top-performing funds from a couple of decades ago, they don't even exist anymore.
So chasing after those superstar funds is probably not the best strategy.
It's a gamble for sure.
Okay, so no consistent outperformance, past performance doesn't guarantee future results.
Right.
What else is there to worry about?
Well, this brings us to pitfall number 6, the cycle of disillusionment.
Oh, okay. That sounds depressing.
It can be, so imagine you invest your hard-earned money into an actively managed fund.
Yep.
You're excited about the potential for those amazing returns, but then year after year, it just keeps underperforming.
I could see how that would be pretty frustrating.
It's a letdown, and a lot of people get discouraged.
Yeah.
They start jumping from one fund to another.
Oh, so they're like chasing returns trying to find that one magic fund.
Exactly. They're trying to catch lightning in a bottle.
But does that ever actually work?
Rarely, each time they switch funds, they might incur those upfront sales commissions again.
Right.
And other fees, which just digs them deeper into a hole.
So they're losing money trying to make money?
It becomes a vicious cycle.
This is all starting to sound pretty bleak.
I know it's a lot to take in, but don't worry.
Okay.
There's another way.
There's
Yes. And that's where passive management comes in.
passive management.
With the world of low-cost index funds.
Okay, so instead of trying to outsmart the market,
Right.
you're basically going with the flow.
You got it. You're accepting the market's overall performance.
It's kind of like accepting that the market has its own rhythm and we can just dance along with it
That's a great analogy.
instead of trying to lead.
Exactly. And index funds are the perfect partners for this stance.
Index funds, I've heard of those,
They're designed to track specific market indexes.
like the S&P 500.
Exactly. That's a very popular one.
And so instead of trying to pick individual stocks,
Right.
you're basically buying a tiny piece of the entire market.
Precisely. You're getting diversified exposure.
Okay, and because they're passively managed,
Right.
their fees are lower.
Much lower. Remember those expense ratios we talked about?
Oh yeah, the termites eating away at my returns.
Well, with index funds, you can say goodbye to those exorbitant fees.
That sounds pretty good.
Lower costs mean your investments can grow more efficiently over time.
But what about returns? Can index funds really keep up with actively managed funds that are supposedly picking all the best stocks?
That's a common question, and the research is pretty clear on this one.
Okay.
Over time, the equity portion of your portfolio should perform in line with the asset classes you've invested in.
So if I'm invested in a broad market index like the S&P 500,
Yes.
my returns should generally be about the same as the overall market performance.
Exactly.
Interesting. And historically, what kind of returns has the S&P 500 delivered?
Historically, it's been around 10% per year on average.
10% per year.
Of course, past performance doesn't guarantee future results.
Right, the market can be unpredictable.
Exactly. There will be good years and bad years.
But even so, 10% on average sounds pretty good.
Especially considering all the potential downsides of active management we talked about.
Yeah, I'm starting to see the appeal of passive investing.
It's all about taking a deep breath and trusting the market's ability to grow over the long term.
It's like planting a seed and just letting it grow naturally.
Exactly. You don't have to micromanage every little thing.
So passive investing is all about keeping things simple, minimizing costs, and just having faith in the market.
That's a great way to sum it up.
This is making a lot of sense, but we've been talking a lot about the S&P 500.
Right.
What if I want to invest in other types of assets?
Like bonds or international stocks.
Yeah. Does passive management still work in those cases?
Absolutely.
Yeah.
That's where the real beauty of passive investing shines through.
It does, yeah. It's all about diversification, right?
Exactly. You don't want to put all your eggs in one basket.
Makes sense.
Mhm.
So how does passive investing help me diversify my portfolio?
Well, just like we have index funds that track the S&P 500,
Right.
there are index funds for pretty much every other major asset class you can think of.
Really?
Bonds, international stocks, real estate, even commodities.
Wow. So no matter what I'm interested in, there's probably an index fund out there that can give me exposure to it.
Most likely. And because they're passively managed, the costs are usually much lower.
So I can diversify my portfolio without breaking the bank.
Exactly. That's the beauty of it.
Okay, so let's say I want to add some bonds to my portfolio.
Good idea. Bonds are generally considered less risky than stocks.
Right, they can provide some stability.
Exactly. So you could look into a bond index fund that tracks something like the Bloomberg U.S. Aggregate Bond Index.
Okay, and what if I'm interested in investing in companies outside the U.S.?
You could consider an international stock index fund.
Are there a lot of those to choose from?
Oh, yeah, tons. A popular one is the Vanguard Total International Stock Index Fund.
And what does that one track?
It covers a broad range of stocks from both developed and emerging markets all over the world.
So I could potentially have a piece of companies in Europe, Asia, everywhere.
Pretty much.
That's amazing.
Yeah.
So using just a few index funds,
Yeah.
I could create like a really diversified portfolio.
That's the idea. It's all about finding the right mix of assets that aligns with your individual needs and risk tolerance.
But how do I know which index funds are right for me?
That's where a little bit of research comes in.
Okay.
You need to consider things like your investment goals,
Right.
how long you plan to invest,
Right.
and how much risk you're comfortable with.
So there's no like one-size-fits-all approach.
Exactly what works for one person might not work for another.
This has been so helpful.
I'm glad to hear that.
We've covered so much ground today.
We have.
The potential pitfalls of active management,
Right.
the advantages of passive investing with index funds, and even how to diversify across different asset classes.
It's a lot to take in.
It is, but it's really given me a new perspective on investing.
That's what we were hoping for.
So if you're listening out there and you're tired of all the stress and complexity of trying to beat the market,
Yeah.
maybe it's time to consider a simpler approach.
Keep it simple.
Embrace the market's natural growth through passive investing. And who knows, it could be the key to unlocking your financial future.
It's definitely worth considering.
Absolutely. Well, that's all the time we have for today's deep dive.
Thanks for joining us.
Until next time, happy investing, everyone.
See ya.